Talk about inverted yield curves, am I right?
So those were actually my mid-year bets. I had my mid-year predictions. I actually have different end-of-year predictions.
All right, let's move on before I get upset.
Because you're losing every bet. No recession, 375. What else do we bet on?
I'm not losing every bet. What are you talking about? Price of Bitcoin, I bet you it's closer to my target than yours.
20,000 versus 40,000? No, it actually isn't. Oh, was it 20 and 40?
Oh, asset class of the year. I think I got you there.
Yeah, if you go through all the bets, maybe you'll win one of them.
Unemployment. That's going to be
Listen, people, if you want a financial advisor that knows the future, come talk to me. If you want someone that sounds good but gets every prediction wrong, talk to Marcos.
But God, do I sound good.
You want someone who's confident that they think they know what they're talking about and they sound like they know what they're talking about, but really don't? That's Marcos.
I read it in a book, I swear.
Okay, welcome everybody to another exciting episode of Talk Your Chart. I am Brett Horowitz here with Marcos Segura. Marcos, what's on every client's mind? The debt limit. So we're going to lead off with that to start. We've got, what do they say, roughly 8 days left to figure this thing out. And
first,
we were talking before the episode how I was surprised back in 2011, the last time this became a big issue, that the debt limit had been raised a couple days before the actual deadline. And then stocks dropped, and then bonds rallied, and then the U.S. Treasury or our credit got lowered. So I was surprised because this seems very similar to that. What is your thought about chances of us actually getting something done before the first?
I think the chance of us getting something done before the first is probably a number greater than 90%. And I think markets will respond similar to how they did in 2011.
So you're expecting a big drop, because here's the first chart here. This is the drop from July of 2011 to September of 2011. So this encompasses when things were getting crazy. And we can see here that the left two sort of sections of the right part of the chart are your equities, pretty much everything down across the board over that 3-month period. And then the right, you've got your fixed income and commodities. One thing surprising to a lot of people is that Treasury bonds, the thing you'd be most scared about holding, because considering you weren't sure if you get your money back, actually rose in value. Flight to safety, people jumped out of stocks and went into bonds.
Yeah, exactly. I'll avoid spiking that in the whole reserve currency conversation. But looking at this specifically, this is not surprising. And
But you think it's going to happen again?
I think it happens to a lesser degree simply because I still think the biggest mover of markets is the Fed, not this. That's it. I think we remain what technical people love to call range bound, where vol has been up, but we've been going nowhere really. Although obviously year to date, we've been just grinding higher.
I mean, people in general don't seem too concerned. As I've got a chart here of the VIX, the Volatility Index. And this goes back, I think it's five years or so. And we can see a huge spike with COVID in March of 2020. But where it is today, it's low. I mean, it's as low as it's been for a while. It's not spiking at all. So people are concerned with 7 days or 8 days to go. It's not showing up in the cost of insurance and the volatility of the market.
I think you've seen it some in the credit default swaps for U.S. bonds and stuff, but I agree the vol's not crazy. I think you can't get away from what's going to move the market the most, Federal Reserve and recession stuff. And this isn't either of those things. So I think it's negative for markets because of the emotional bias towards thinking this is going to be like fracturing our infrastructure. This makes democracy look bad. That's why we got downrated last time. But ultimately, quality and safety is still found in US dollars.
Yeah, but doesn't this make everything worse? I mean, if this happens again, markets drop 15%, you've got this crisis of confidence, you've got the government who can't get their stuff together, you've got potential downgrades, everyone's 401ks and balances go down. Like, it seems to me it's the perfect storm for leading into a recession. Like, if people are nervous, be nervous. And if you're not going to be nervous, then the market should not go down 15%.
Yeah, I like your second chart.
Yeah, I mean, this is basically one month before the debt ceiling crisis in 2011 and 2013, which was the last two times we got this close to not solving the issue, and then 1 year after. So I know a lot of clients, ask, what should I do? Are you nervous? Should I take my money out, put it into bonds, not even treasury bonds? And my whole thought is this is a short-term event, right? It's a man-made event. It will go away in the relatively near term. Markets will come up going forward. And I don't look at it as anything like jump out, because if you jump out now, you could miss a big rally if they get their act together.
Yeah, I agree. But again, I'll just harp on the point that this is a headline now. It's the biggest risk that we are, you said it perfectly, man making as a risk unnecessarily. I think the two sides get together and just get it done because they look silly if they don't. You saw presidential front runner for the Republican nominee, Donald Trump. He says that there should be no deal done at all. So we'll see if cooler heads prevail. So these recovery blue bars here are awesome, but the economic circumstances are different in 2011 and 2013 compared to now. Which one of these? I think it was 2011 had the Greek financial crisis and debt crisis baked into there also. But we're looking, again, some of us are predicting recession towards the end of this year, going into 2024. So how that impacts corporate earnings, which ultimately that's what the markets care about, is yet to be seen. So I wouldn't be surprised if the 12-month return from now isn't above 20%, just because you have to work through a bunch of other stuff. But ultimately, short-term noise, I'm not going to make any long-term decisions with it.
Well, I think a lot of people, I mean, I've got a chart here showing that a lot of people are making short-term decisions with what's going on. And so you can see here.
Not me, Brett, not me.
Good job, Marcos. You've listened to the episode long enough. But here's U.S. equity fund net inflows, which is sort of the green positives, or net outflows, which is the gray nut bars below that. We told our listeners over and over again that when the market is down 1 year, the expectation is it's almost always been up the following year. This has been a good year so far. And what do we see? We see people taking money out of U.S. equity funds. Why? Why are people doing that? Based on the risk of a recession, based on the risk of debt ceiling, based on Ukraine? I mean, I guess there's lots of reasons, but it hasn't worked out for them.
I know. Fund flows are always so tricky to me. Like whose funds are those? Huh? I'm pretty positive it's picking up advisors and retail.
Probably. Yeah, I think it's everything, aggregate. So you got professionals and you've got your amateurs, and all in total, people are taking money out at the wrong time.
And it's US equities. But okay, so counterfactual. Is it because they're leaving US equities and going to international equities?
Could be, but US has done pretty well this year, up 10% for the year so far.
What about international equities, Brett?
Up more than that?
Up more than that. That's right.
You really think that all these people are so smart to get out of US and get into foreign? I don't think so.
Look, I just gave you a little counterfactual there. Okay, something to think about. They're not necessarily putting it under their mattress, or they're doing what a lot of people are doing. Let's get out of the market, wait for the dust to settle. Let's go earn 5% in a money market, because that's awesome. Except a year from now, it's not going to pay you 5%. And if they're not paying you 5%, it's because rates dropped. And guess what happens if rate dropped? You miss the market rally.
Well, even 5% is not something that I get. I mean, it's great compared to years before, but if it's 5% with inflation at 2, count me in. 5% with inflation of 4.9, I'm not sure I get too excited about it. Not to mention that if the market, we showed charts before, market takes a year to recover from where it is today. Over 2 years, you're talking about a 15% return, or 7.5% over 2 years. Much better than the 5 that a bond would give me.
Yeah, and it's not going to be 5, and that's my favorite chart to show. Like the 2 years recovery from today, which again is a crazy recovery time because we've already been over a year. So that's total over 3 years of recovery time, which would be on the longer average of recoveries. But say it does take 2 years, you're annualizing it over 8.5% on the S&P. So like, come on, 5 years from now, like you're going to be in a better position. On top of the fact you get 5% over the course of 12 months. And that's not going to happen because rates are going to move.
Right. Rates are going to come down. If they don't, I mean, I guess that'd be really fantastic for the economy if rates were still at 5%, but I don't think anyone's expecting that.
All right, yeah. So let's roll that right into inflation and a little bit of rate stuff that I had for us. We've seen this chart plenty of times. I bring it up again just because there's people predicting, Mr. Horowitz, that inflation, CPI, is going to be 2% by the end of next year. How is that possible if everyone's so worried about it? So this is from our friend David Kelly. On the inflation front, news continues to be encouraging. Year over year CPI has fallen from a peak of 8.9%, which is a super red number, from June of last year to 5% in April. So energy, airfare, hotel, all stabilizing and declining now in food and used car prices. And what this gentleman is saying is he thinks we get year-over-year inflation falling to 4% in May, and then between 3 to 3.5% in June. And then since rental inflation is delayed and lagged, we get below 4% through the end of 2023, and then sliding steadily to 2% over the course of 2024. If that's what's happening, the Fed needs to stop doing what it's doing, right? And pause.
I think I said that last episode. The Fed needs to stop doing.
Well, I said it the episode before that, all right?
David Kelly, though, to not to take the opposite side here, he tends to be pretty bullish about how the markets will do. So I hope he's right, but inflation has been stickier than most people thought. Right? I think a lot of people thought by now we would have seen 0.2s and 0.3s come off inflation, and you're seeing some 0.1s and barely any movements in the last couple months.
Yeah, that core services X housing, which is what the Fed looks at, is clocking in at 0.3, which is kind of what you want, that 0.2 to 0.3. So we'll see. And I think ultimately everyone would be fine with a 3 to 4% handle on inflation. Just get off the 5.
There are more Fed members of the Fed who have now said, yeah, I might consider being okay delaying and waiting and not increasing this next hike in the middle of June. But it doesn't sound like anyone's ready to say we're done for good. It sounds like they're ready to pause and see how things play out, but I'm not sure they're done.
They're done. They did the job.
I think they're done.
Rate is above CPI.
I don't think they think they're done.
I think they're trying to not let the market think they're done because they can't have anything undone. But next chart, and this is also just solidifying my prediction. Net percentages of U.S. banks tightening lending standards. Look at that big spike, Brett Horowitz. I know it's only 46%, up from 45% last month, but they took this reading. And this is, so who's answering the survey? And let me just, so this is the Fed's April Senior Loan Officer Opinion Survey. So these are the senior loan officers. They know what they're talking about. Credit conditions tightening. This is also helping the Fed do its job for them. As credit conditions getting tighter, main downward pressure on inflation because the consumer is not going to be able to get money and businesses are not going to be able to get money as freely as they previously were. What happens, Mr. Horowitz, after we get spikes in credit tightening? What happens? What are those gray bars?
Sometimes they're recessions. Sometimes they're not.
Shallow recession, not systemic. That would make sense to me.
This is why the Fed has said we might stop raising rates because of what's happened with the big banks, what's happened with a lot of lending out in general. They think there could be more shoes to fall from this whole banking mess. And so it makes sense that they're going to pause, or hopefully they're going to pause in June and sort of allow this number to not continue to creep up.
Yeah, and I paired this simply with a little snapshot of what consumer finances look like. As a reminder, that's about 80% of our GDP, meaning it's real important. And it's been said too many times, so we'll say it again. Don't bet against the US consumer. We love buying stuff that we can't afford, which leads to credit bubbles and then a clearing of all that, and we start all over again. But if you look at household debt service ratios, if you look at the early delinquencies, which are awesome little forward indicators as to what consumption is going to look like over the next 6 to 12 months and what, again, the whole potential recession is, it's still nothing that's just flying off the charts. So you still have a good consumer. Yes, it's probably, I mean, not probably, it is trending worse, but it's off such a wonderful spot that it just smells like shallow recession.
Or no recession in my case. But
Yeah,
you're
or
right.
shallow one, Brett. That starts in Q4 of this year.
As we said, Marcus, you can't just will it to happen because you keep saying it over and over again. Okay.
Look, our listener is a big spender, and once they start pulling back,
I don't think so. I mean, our listeners either have a job or they're retired and they listen to us and they've got enough money to do what they want to do for the rest of their life without having to go back to work.
I know. Okay, well, so we got
So
for you.
the only other thing I'll mention is that while all these charts seem to suggest things that could happen in the future, by no means do they actually predict what will happen, right? Like you can't say, I've had clients before say, what happens in the summer typically with the markets? What happens in the fall with the markets? Yeah, sometimes they say sell in May and go away, or September is the worst month, but it's not like you can use these charts to make predictions about what's going to happen, because if it happened every single time like that, it'd be easy to get out in front of that and just do the opposite before it happens.
Too many individual factors go into all this stuff, and then you have to overlay human behavior. Good luck with that.
So I want to tell a story from my early childhood, which I think is sometimes appropriate.
Are you sure?
Yeah, I think it's funny.
Okay.
So were you ever involved in a a stock picking competition in Berlin or in high school or anywhere?
I did it once in college, I think.
College, okay. We had a competition back in 8th grade. And a friend of mine who's still my friend, we were picking stocks. I remember we had Gillette, we had Nike, I think we had an airline in there. We didn't know what we were doing, but we were picking stocks that we knew because, hey, it's, near the holiday season and we think that these things are going to sell really well during the holidays.
Sounds intuitive.
Huh?
Sounds intuitive.
Yeah. So going into the winter break, we were in like 450th place out of 500 teams. It was really bad. We were a little disappointed, but it's just bad luck. We had great stocks. We had a great reason for owning the stocks. Just bad luck. We come out of in these days there was no internet, so everything was done via the newspaper. So we saw a stock that every day would be up like 20 points or down 30 points. We're like, stock is crazy. It was a Japanese 7-Eleven company called Ito Yokado, and we put it in our portfolio. No other reason than it would be exciting, and we needed something big to hit. Right, we were very far behind. We come back from winter break. We're in the top like 70 out of the entire state of New Jersey. This Ito Yokado shot to the moon. And so it just sort of showed, to me, it showed us the whole, going from awful to great. And suddenly it was like, you guys are terrific. You're geniuses. How'd you do that? When for weeks and weeks, we were just near the bottom of the barrel. So I use that story simply to say, like, you can have a great thesis. You can think what's going to happen. You've got these rules that you sort of tend to apply to, but there's a lot of luck involved. And so when you get it right, it usually is luck. It's not skill.
How do you differentiate between luck and skill, Mr. Horowitz?
Consistency.
Persistence. So how's your stock picking been going ever since then?
I've given it up. No more stock picking. Index funds only.
I thought you picked Cisco this year.
No money's on Cisco though.
Huh. Interesting. Oh, I just so happen to have the chart up of Cisco, the company you chose, and Intel, the company I chose. And Intel's up 16% on the year, while Cisco's up 4% on the year.
So this sounds like the story I just told. We head into a break. I'm getting
There's
crushed.
no Japanese 7-Eleven over here, buddy. I got momentum. I got tailwinds.
We shall see. I'm not worried about it. I'm winning all the other bets, which Marcos did not mention.
Okay, fine. Another time, another episode.
Alrighty. Let's hope that the Congress gets things together and figures this stuff out.
Until next time, thanks for watching.